Hello everyone. Today's class is about how to practically use the financial statement in terms of business management, including the international business management. And so, all right, let me start today's class with this slide. All right. So every business managers must, have a good knowledge about the financial statement because the financial statement is actually the primary source of communicating within the firm and also outside the firm. So, making financial statement useful for users is actually one of the primary financial goal. And the important goal of the content is to report financial information to the user in the form of useful for decision making. So, many of the firm has a different size and different operation. So each the company's the financial statement is very useful for the company. But if we want to compare the different, the companies, the different financial statement, we need to use some, very technical, the analysis, like common size statements and the financial ratios. So today we are talking about those two, techniques. Primarily on the financial ratios, financial ratios analysis. Right. So first, look at the common size financial statement analysis. So this is very straightforward, you know. So this is just to convert, the traditional financial statement into the common size, the financial statement, in order to compare the different size of companies or different operation companies. So for like this, the compute all accounts of the balance sheet as a percent of the total assets or the percent of the total liability, and percent of the total equity. And in terms of income statement, just compute all line items as percent of sales. So these kinds of standardization makes the financial statements to compare each other. Particularly for the different industry or different, the size, the companies for the analytical comparison analytical purposes. Right. So the slide from the slide 4 to 9 shows an example. Let's say the preferred corporation. So the slide 4 shows you the preferred corporation's balance sheet. It's of December 31, 2022 and 2023. Slide 5 shows you liability and equity. So this is the traditional balance sheet. But we can convert this traditional information into a more common-sized balance sheet information, like slide 6 and slide 7. So it is very easy, So to make the total assets as a 100% and just convert each account of the assets, as a percentage of total assets. And also each account in the library and equity just convert to the percentage of total liability and equity. All right. So we can just compare these, converted percentage from across the different companies, right? Let's see the income statement. The slide 8 shows you the traditional income statement. And we also can convert this traditional income statement into a common size income statement, or like in slide 9. So let's make the sales as 100% in each account of the income statement. Just let's convert into percentage of sales, like cost of goods sales is 50.2% for the group corporation, right? So like this. So far we just look at how to convert, how to make the common size balance sheet and the common size income statement for comparison purposes for the different size and different operation companies. So we can understand now. It is very straightforward and very easy to understanding. And now let's move on to the ratio analysis. I think this is one of the most common practice in the financial statement analysis. So I think you need to understand and you need to keep in mind which ratio we need to use whenever we just want to analyze the financial, the condition of each company. So let's look at one by one the ratio analysis. And the first, I just refresh you that the problems of the ratio analysis. The one problem with the ratios is that different sources frequently don't compute them exactly the same way, which means that the ratio analysis can be different by the different sources or different people, how to make. So I think this is very, this is very cautious for you to understand the ratio analysis. So you need to, you should be very careful to document how you calculate each ratios if you compare your ratio analysis, ratio numbers to, to analyze for your the analytical purposes. So the first of all you need to clarify is that how is the ratio computed and what is the ratio trying to measure and why? What is the unit of measurement and what does the value indicate? And how can we improve the company's ratio? So like this, you just, you need to check, which numbers are used and which is the definition of the ratio in this, analysis. So after that, checking and identification, and then you can just use the ratios for your analysis. All right, so let me explain about the major categories of financial ratios. The first one is the short-term solvency and the liquidity ratio. And the second one is long-term solvency and financial leverage ratios. And third category could be asset management or turnover ratios. And another category is the profitability ratios, which is I think, the most common ratios for the ratio analysis. And also you can, check the market value ratios with the use of the financial, the numbers. So let's continue to explain about the ratios, just using the financial statement on the previous slide of, for example, the preferred corporation, right? Right, let me start with the short-term solvency or the, short-term liquidity measures. When you're talking about the short-term solvency ratios, that we can say the one advantage of looking at the short-term solvency ratios, like a current asset and liability is the account that book value and market value is very close, is very, very similar, because this is a short-term account. So that's why for these measures, the book value and the market value is quite similar. So this is a very good advantage of looking at these ratios. But for another, disadvantage of looking at the short-term solvency ratios is that these short-term ratios can be changed very rapidly because, this is just a short-term ratio. So nobody secured that today's amount could be continued till the tomorrow, right? So today's ratio is not much reliable guide to the future because that is the short-term ratios, right? So you need to keep in mind with these advantage and these disadvantages of these short-term ratios. All right. So there's several short-term solvency ratios like current ratio and quick ratio and cash ratio, right? And we can say that from the creditor's perspective, such a short-term solvency ratio is very, very useful because the creditor is most of the time very interested in the company's, the capability of the solvency, like a supplier. They are very interested in the company's the capability of the payment in the short term. So the higher the short term ratio, they just feeling that it is better for the creditor. How about in terms of the firm? If the short term ratio, like a current ratio, is higher, I mean, which that means that the liquidity of the company is good, right? So it it is a very good aspect for the company. But however, right, at the same time, the higher short-term ratio, short-term service ratio, indicate an inefficient use of the cash. You for the most of the time, uh, as the liquidity of the asset is higher, the return of that asset is lower. So liquidity, the relationship between the liquidity and return is just a trade-off. So that's why the higher current ratio indicate an inefficient use of the cash of the company. So that is like one of the you know the disadvantage of this ratio implies, right? What about the the current ratio is less than one, which means the current asset is lower than current liability. So this means that you know is is their liquidity asset is not enough to cover their current liability, right? So this is not good for the business in the most of cases, right? So current ratio is directly related to net working capital. So you need to understand, how the company is a good shape in terms of liquidity or not. So if you look at the current ratio, right? Right. Just the current, I just explained the current ratio is the service ratio is defined, right? Current asset over current liability. So for the example of the preferred corporation, it was 1.3 times. Just you know, you can verify this ratio from the balance sheet, the current asset and current liability. Current asset, you know, current liability, you know. So you can check, you can verify these numbers from the balance sheet and the income statement. So yeah, for the preferred company corporation, that the current ratio was 1.31 times. What does it mean? So we could say that preferred corporation has a $1.3 in current assets for every $1 in current liability, right? Or we can say the preferred has its current liabilities covered 1.31 times over, right? So this is very clear. And but the current asset actually include the inventory. But the you probably know very well. The inventory is the one the least you know liquid asset as a number, right? So we need to like just subtract inventory from the current asset to measure more accurately of the current asset, right? So that ratio is the quick ratio. We call it quick ratio. So current asset subtract inventory as a denominator, and its denominator is the same to the current ratio as the current liability. So this, this ratio is more accurate in measuring, the short-term solvency of the company. So let's say that, let's say that if you use the cash to buy the inventory, what happened? It does not affect the current ratio, right? But it reduced the quick ratio because the inventory was subtracted, right? So for the preferred corporation's example, the quick ratio is 0.53 times. So it's much less than the current ratio, So which means that the preferred company include a lot of inventory as a current asset, right? So we need to check the quick ratio as a measure of short-term solvency. So let's take an example, right? If the company has more and more fixed assets, right? I mean, again, the let's take an example of nuclear power plant. If the if a certain company have a nuclear power plant as a inventor, right? So it's a very it's a very difficult to say that this company has a very higher short-term solvency ratio. So, but if we just measure as a current ratio, we can say that this company has a higher short-term solvency ratio. But if we just measure as a quick ratio, we can say that this company has a very relatively lower short-term solvency ratio. So this is the reason why we need to track with a quick ratio for measuring the short-term solvency ratio of the company. All right, and let's see the cash ratio. Cash is most the liquid asset. So if we measure just the cash as a denominator, we can measure very accurate, most accurately measure the short-term solvency. So very short-term creditor might be very interested in the cash ratio instead of the current ratio, right? So these three different types of short-term solvency ratios just give some implications about the short-term solvency of the company. So you need to use these different short-term solvency ratios at the same time, and a check and balance. Yeah, that is the liquidity short-term liquidity ratios. All right. So let me move on the long-term solvency measures. So long-term solvency ratios are, just intended to, measure the firm's long-run ability to meet its obligations, right? So we call this as another term, right? like financial leverage ratios or just leverage ratios, right? What are those the leverage financial leverage ratios? First of all, we can see the total debt ratio, which is the you know total debt divided by total asset. So for our example, the preferred corporation has 28% of the total debt ratio, which means that preferred has $0.28 in debt for every $1 in assets. So, which means there is 0.72 in equity for every 0.28 in debt. So, so we can so we can define another ratios from as a derivative from the total debt ratios, like debt equity ratios, which is defined by the total debt divided by total equity. So for our example, the for corporation was this ratio is 38.6%. And also we can get another ratio is equity multiplier, which is defined by total asset over total equity, which is equal to B 1 plus total debt over total equity, right? So for example, this ratio is 1.386, right? So we can get these different kinds of financial leverage ratios from uh, total debt and equity and total assets. Right? And or there are another types of long-term savings measures, which is the interest coverage ratio, right? Interest coverage ratio and cash coverage ratio, right? So we defined interest coverage ratio like this. Time you call interest coverage ratio as another term is times interest on. So EBIT divided by interest, right? So this measure indicate that how well a company cover its interest obligations. So for our example of the preferred corporation, this ratio is 4.9 times, which means that the preferred interest bill is covered 4.9 times over, right? And also we can get the cash coverage ratio, which means EBIT plus depreciation divided by interest, right? What is the difference from the interest coverage ratio is the EBIT plus depreciation, because depreciation is deducted as a non-cash expenses, so we need to add the depreciation uh, above the EBIT, so as a nominator, so for measure the cash available to pay interest more accurately. So So this is, for the our example, the corporation, what this ratio is 6.9 times. So we can identify that this cash coverage ratio is higher than time interest earned, right? So because the cash coverage include depreciation as cash, you know, just to add back, right? Depreciation as cash available, right? All right. So far we are talking about you know the short-term solvency ratio and long-term solvency ratio, right? At this time, we move on to the another types of ratio, like turnover ratio, right? Asset management, asset turnover ratio, right? So, and and in general, the turnover ratio, the measures the efficiency, how efficiently the firm uses its asset, right? How efficiently a firm uses its like you know uh, you know receivable, right? As an asset, inventory as an asset, right? So this measure is measuring about the efficiency. So so let's just take a look at this efficiency ratio from you know the inventory and the receivables point of view. Right. Let's see the inventory turnover. What's the inventory turnover? Inventory turnover is defined as cost of goods sold, divided by inventory, right? So as long as we are not running out of stock, the higher the inventory turnover ratio means the more efficiently the company manage their inventory, right? So for our example of the corporation, its ratio is 3.2 times. So what this means, this means that this company, you know, turned over entire inventory 3.2 times during the year, right? So which means that you know 3.2 times is a high number. So this means that the preferred corporation is efficiently manage the inventory, right? And if we get the inventory turnover, we can just convert this turnover ratio into the days sales in inventory, which is the duration. How long it is take to cover the inventory? How long is it take to inventory seats you know until it is sold? So for our example, the broker corporation, this ratio is 114 days, which means the roughly speaking, the inventory is about 114 days on average before it is sold, right? So this is another expression about the inventory, you know, turnover, right? So this is user ratios of the company. And let's move on to the receivable ratios. So it's the same manner, the same. We can calculate the same way, like inventory. So receivable turnover is defined as sales divided by account receivable. So for our example of the preferred corporation, it is 12.3 times. So what this means? It means that we collected our outstanding credit accounts and lent the money again 20.3 times during the year. So, and we can we can convert this turnover ratio into how long it is take, to collect the credit sales, right? So, so we can express this number as a days sales in receivable, so which is defined 365 days over the receivables turnover ratio. So for our example of the preferred corporation, this ratio is 30 days. So which means on average we collect on our credit sales, about 30 days, right? So we can call this another term like average collection period. So we can say that we have 30 days worth of sales currently uncollected, right? So, and just we look at as a big picture, we can, measure by using the total asset turnover, so which is defined as sales divided by total assets. So for our, instead of individual, inventory or the receivable, right? So for example, this ratio is 0.64 times. So which means that for every dollar in assets, we generate 0.64 in sales, right? So if a firm has a large amount of fixed assets, the total asset turnover it can be less than one. So it is not unusual for total asset turnover is less than one, because there are many of the corporations has a large amount of fixed assets, right? All right, let's move on to the profitability measures. This is the most common measure in the ratio analysis. No, so this ratios is the measuring how efficiently the firm uses asset and how efficiently the firm manages its operations, right? So one of the most popular, profitability measure is the profit margin. It is defined by net income over sales. So for example, that this ratio is 18%. So this tells us that for a corporation generated little like 80%, 18% in net income for every dollar in sales. So and also we can use the EBITDA margin instead of the profit margin. EBITDA margin just use the EBITDA as a nominator instead of a net income. So EBITDA actually measure more general operating cash flows than the net income. So we can use this ratio instead of profit margin. All right. And whenever you interpret the profit margin, you know, you need to be very cautious that for example, the lowering price is tend to increase the volume, but normally cause margins to shrink. So total profit can go up or down, right? So the fact the margins are smaller is not necessarily bad, right? So because even if the net profit margin is going down, but in other side, the the sales volume can increase. So you need to check both the sides, net margin, profit margin as well as the volume, right? So you need to be very cautious. Let's see another, profitability measure, which is most common ratios in the ratio analysis, right? The return on assets, return on equity, right? So return on asset is a measure of the profit per dollar of assets. So for example, the preferred corporation, that is 18.65%. What is return on equity? Just measure net income over total equity instead of total assets. For example, that ROE is 16.15%. So actually, the ROE is most important, the ratio, because that is the measure of how the stockholders, fared during the year. Because the maximize the shareholders' interest is one of the most important financial goal. So ROE is so important, right? So actually the true bottom line measure of performance of the company. So like for the proper corporation, so generate like 16% in profit for every dollar in equity, right? So that is the meaning of the ROE. But you need to keep in mind that the ROA and ROE are, accounting rate of return. So we can say that that's why we can say that return on asset as like a return on book assets and return on equity as like return on book equity. So because that is accounted by the accounting value, book value. So we need to cautious to interpret these numbers because that is based on the accounting measure, not the financial measure. You know, so you need to always keep in mind. And for our example, the ROE exceeds the number of ROA, which means that the preferred corporation use the financial leverage, right? So that's you can, this is the one point you can, capture from this example, from this ratio. And finally, we can just look at the several like market value measures. These measures is pretty popular measures in the financial market because that these the market based measures is measured by the market value in the market, right? For example, the market cap, is the number of shares times, price per share, right? So, generally speaking, we if we you know if we just measure, we measure the total market value of the stock, just we can calculate the market cap, right? What are the P ratio? It's price earning ratio, right? So it's the price per share divided by earnings per share. So for our example of the for corporation, it is 8 times. So so this is the that means the preferred shares sell in the market for about 8 times earnings, right? So P multiple of 8, right? So because the P ratio measures how much investors are willing to pay per share dollar of current earnings, so higher P's are often meaning meaning that the firm has a significant prospects for future growth, right? But you need to just to be you need to cautious to interpret in terms of interpreting this ratio, because if a firm had very small earnings, they can have a higher P ratio. So just you need to very cautious to check the component of the P ratio. So if the earnings per share extremely low, so you need to check whether the earnings per share is extremely low or not. So generally speaking, for example, in the U.S., the P ratio in 2021 was the around the 35, and historically the lowest P in the U.S. is in 1974. That was 5. It is extremely low. In 2009, that was 70, extremely high, right? Just after the financial crisis. So because there's lower earnings, right? Now, also, P is different across countries. For example, the Japanese P's historically stays much higher than those of the US, right? So you need to just to check the historical values of the country, or what about the cycle of the business cycle, and what about the level of the earnings. So you need to check the many aspects in terms of interpretation of the P ratio. Another measure is market to book ratio. which is the market value per share divided by book value per share, right? For our example, was 1.12 times. A very less than one of the market book ratio is meaning that the firm has not been successful overall in creating value for its stockholders, right? What about the enterprise value? Enterprise value is more comprehensive measure. Is is a value of a market cap plus market value of interest bearing debt minus cash. So which means the market value of the asset except the cash, right? So you can identify that the enterprise value for corporation 3,462 million is much higher than market cap of that corporation 2009 or 4, right? Finally, we can get the EV multiple. So which is called the EBITDA ratio. So enterprise value over EBITDA, right? So that is the 3.58 times for our example. So this EBITDA ratio is very similar to the P ratio, but it indicate the variable all of the operating assets, you know. So to a measure of the operating cash flow generated by those assets, right? So this is a more comprehensive measure to compute the market value of the company, right? So, right. These are the major, ratios, you know, commonly used in the ratio analysis. So I think it is very valuable for you to understand what the financial statement of the company is telling you about the financial condition of that company. So if whenever you understand the financial condition of the business management of the company which you are very interested in, you need to check these ratios at first, and then so look into more the account in the balance sheet or income statement or the financial market measures. So that is the our that is a summary for the today's the class today's class, right? All right. So all right, let me stop here, and thank you.